So next concept, a very familiar concept, we have materiality. So we have discussed this even from the first topic in this course, which is the introduction to assurance services. So let's just review some of the more important concepts related to materiality. So we have already established that materiality is a relative concept. So what is material to one entity may not be material to another entity. And when do we consider the information as material? Information is considered material if it affects the decisions of the users when that information is omitted or misstated, taken on the basis of the financial statements. And then finally, the assessment of what is material at the end of the day is still a matter of professional judgment of the auditor. So you have to consider your knowledge. You have to consider your experience. So you have to consider your training. So when determining when a matter is material. So that's what we meant by professional judgment. So as discussed in the previous part. So next, the concept of audit evidence. So when we say audit evidence is all the information used by the auditor in arriving at the conclusions on which the audit opinion is based. So meaning to say, not all documents of the client, not all available evidence in the client are considered audit evidence. Only those used by the auditor in arriving at his or her conclusion would be considered audit evidence. And what comprise audit evidence? Audit evidence includes both accounting records and other information. Accounting records include journals, ledgers, and worksheets. So those books of accounts, supporting documents on those books of accounts are considered part of our client's accounting records. On the other hand, other information includes all types of evidence that are not classified as accounting records. So it is a kind of a residual definition. So example of other information are minutes of meetings of the board of directors or result of the auditor's procedure such as inquiry and observation. Or even third-party information like information from other companies, they are considered as other information. So in old auditing standards, other information is also called corroborative information. So in the past or in the previous iteration of our auditing standard, audit evidence comprised of accounting records and corroborative information. So but in the present form of our standard or version of our standard, audit evidence is known to comprise accounting record and other information. Okay, but those are identical terms, no? Other information and corroborative information. Another important concept is that auditors are not expected to address all information that might exist. That's why we mentioned earlier that not all documents available to the entity are required to be used by the auditor. In audit, so we have this concept of selective testing. So meaning to say, we are allowed by our auditing standards to use, for example, sampling in drawing conclusion from a certain population of the client's records or documents. And finally, audit evidence is considered cumulative in nature. So meaning to say, it also includes audit evidence obtained from performing audit procedures during the course of the audit and may include also audit evidence from other sources such as in previous audit or even a firm's quality control procedures that we have performed during client acceptance and continuance. So next concept, we have management assertions, so which we already introduced in the previous topic, ASR-02 Introduction to Auditing. So management assertions are representations by management, whether explicit or implicit, so meaning whether expressed or implied, about the recognition, measurement, presentation, classification, and disclosure of various elements of the financial statements and related disclosures. So meaning to say, management representations are assertions are representations contained in the financial statements prepared by the management. And it is from these management assertions that we assess the risk of material misstatements and design and perform further audit procedures. So, meaning to say, we consider these assertions whenever we design our audit procedures. So, because it is from these management assertions or representations where material misstatements may occur. So, we have three major classes or categories of management assertions, or also known or also called as financial statement assertion. So, there are management assertion about classes of transactions, about account balances, and about presentation and disclosure. The management assertions about classes of transactions are normally found in the client's comprehensive income or statement of comprehensive income. So for example, in the statement of comprehensive income, it's there where results of transaction of the client such as sales revenue, expenses are presented. So therefore, the representation about the result of the transaction such as sale to customers, rendering of services to customers, incurrence of expenses are included. So that is why those items included in the statement of comprehensive income include representations by the management related to classes of transactions. Now, representation about account balances are normally presented in the client's statement of financial position. So in the statement of financial position, so we can see there the client's representation about the balances of their resources, their liabilities, and equity interest. So finally, the assertion of presentation and disclosures are present in every item or in every type of financial statement. So whether it is on the statement of financial position, comprehensive income, cash flows, changes in equity, and the notes to financial statement, so representation about presentation and disclosure are present. So let's elaborate the assertions under each category. So under classes of transaction, so we have 5 types of assertion. So number 1 is occurrence, so which means that client represents transactions and events that have been recorded, have actually occurred, and pertain to entity. So for example, in the client statement of comprehensive income, they presented their sales. So they are representing to the users of the financial statement that sale transaction recorded on the financial statement or presented in the financial statement actually occurred for a non-fictitious customer, and that sale pertained to the entity. So another assertion related to class of transaction is completeness. So completeness means that all transactions and events that should have been recorded have been recorded. So meaning, no sale transaction was omitted in the preparation of their statement of comprehensive income. So therefore, let's say if the sales presented would be understated, then that is a violation of their completeness assertion. But if it's overstated, that would be a violation of their occurrence assertion. Next, we have accuracy. So when we say accuracy, it means that amounts and other data relating to recorded transaction and events have been recorded appropriately. When we talk about accuracy, so one thing to remember is that it has something directly to do with the measurement. So measurement of the transactions presented in the comprehensive income. Classification, this means that transactions and events have been recorded in proper accounts or proper account title. So if, for example, it's sale to customer under ordinary course of business, then it should have been recorded to revenue and not to miscellaneous income, for example. So that is an illustration of classification assertion. And then finally, the last one, we have cut-off. So when we say cut-off, transactions and events have been recorded in proper time period. So what is being emphasized in cut-off is the timing. So timing of recording of the transactions. So for example, revenues and expenses should have been recorded on the period that they have earned or they have been incurred. Next category, we have assertions about account balances. So assertions about account balances include number 1, existence, which means assets, liabilities, and equity interest actually exist. So if, for example, the client included, let's say, 1 million pesos of cash in their financial statement, so that means that the company or the entity has actually 1 million pesos of cash in bank or in their hand. Completeness means under account balances, all assets, liabilities, and equity interest that should have been recorded have been recorded. So similar with the completeness that we have mentioned earlier, so it means that all assets that pertain to the entity should have been included in the financial statement. All liabilities are included, or equity interests are included in the financial statements. There were no omission. So, like earlier, so in occurrence, existence pertained to potential overstatement, while completeness pertained to potential understatement. Next, valuation and allocation. Assets, liabilities, and equity interests are included in financial statements at appropriate amounts, and any resulting valuation adjustments are appropriately recorded. So this is something to do with the measurement of asset, liability, and equity interest or account balances. So measurement or proper measurement or allocation of valuation adjustments such as depreciation for PPE or allowance for bad debt for receivable, for example, are properly accounted for. Then finally, we have rights and obligation. So this means that the entity holds or controls the right to asset, liabilities, and obligation of the entity. So meaning if, for example, the entity presents asset in their financial statements, so that means they have right. They control the rights now over that, or they control the benefits over that asset. Or that when they present liability, that is an obligation of the entity. Then last one, we have presentation and disclosure. So this is like a combination of assertion in the account balances and classes of transaction. So the first one, we have occurrence and rights and obligation. So which means that disclosed events and transactions have occurred and pertain to the entity. Completeness, which means that all disclosures that should have been recorded or that should have been included in the financial statements were actually included and presented in the financial statements. Next is accuracy and valuation, which means that financial and other information are disclosed appropriately and appropriate amounts. A combination of measurement, assertion or representation from the account balances and classes of transaction. And then finally, we have classification and understandability. So financial and other information is appropriately presented and described, and disclosures are clearly expressed. Now take note that these assertions are very important in our study of audit procedures, because later on we will learn that when we design audit procedures, so we have to consider or we have to set an audit objective for each of these management assertion. So for example, we have 5 categories or 5 assertions under class of transaction categories, and 4 management assertion under account balances, and another 4 for presentation and disclosure. So we have to set audit objective for each of those assertions. And for each audit objective, we have to design audit procedures. And for each audit procedure, we have to obtain sufficient and appropriate audit evidence.